All right, let's dive in. Today, we're going to break down a really powerful, but also radically simple philosophy for building wealth. We're talking about going from the usual chaos and confusion of investing to a place of real clarity and hopefully financial freedom. The source material kicks off with a question that I think really hits home for a lot of us. You work hard, right? You put in the hours, you try to save what you can, but when you look at your net worth, it just doesn't seem to add up to all that effort. So, what's going on here? Where's the disconnect? Okay, so first up, understanding why most investors actually lose. It turns out the path to wealth is often blocked by some really common mistakes. The good news? They're totally fixable. And just knowing what they are is half the battle. The reason most people don't get the returns they want is because they're playing a game they just can't win. They fall into two big traps. First, they try to be a psychic, guessing if the market's going to go up tomorrow or down next week. And second, they try to be a genius, thinking they're the one who can outsmart everyone else and pick the next home run stock. As you're about to see, both of these are basically illusions. And what's the result of all that effort? Well, it's not pretty. All that frantic buying and selling, trying to be a psychic or a genius, it just racks up fees that eat into your returns. It creates this constant nagging anxiety. And the worst part, after all that, the data shows that for most people, the returns are just mediocre. Sometimes they barely even beat inflation. So, if that's the wrong path, what's the right one? Well, the answer is a philosophy that feels like a shortcut. And just to be clear, this is not some get-rich-quick scheme. It's about finding a smarter, simpler, and way more effective way to build real wealth. And here it is, side by side. The difference is just night and day. On the left, you've got active trading, trying to beat the market, which leads to high stress, high fees, and, get this, a staggering 90% failure rate over the long haul. But on the right, you have index investing. You're not trying to beat the market, you're just matching it. The fees are incredibly low, and the approach is literally set it and forget it. You're swapping chaos for calm simplicity. So what is this powerful tool? It's called an index fund. And honestly, the best way to think about it is this. Instead of trying to find that one magic needle in a giant haystack, you just buy the whole haystack. It's that simple. With a single purchase of, say, an S&P 500 index fund, you instantly own a tiny piece of the 500 biggest and most successful companies in America. This simple idea wasn't always so popular. In fact, when a guy named John Bogle launched the very first index fund back in 1975, Wall Street literally laughed at him. They called it Bogle's folly, like it was some kind of joke. But fast forward to today, and that folly now holds the majority of all investment fund assets in the US. It was a quiet revolution, for sure, but man, was it decisive. Okay, so that covers the what and the why. Now for the best part, the how. Because the real beauty of this whole strategy is that you can put it completely on autopilot. Let's walk through the action plan. The engine that drives your automatic plan is a tactic called dollar cost averaging, or DCA. Now, that might sound a little technical, but it's incredibly simple. All it means is you invest the same amount of money on a regular schedule, like, say, $500 on the first of every single month. It's simple, it's automatic, and maybe most importantly, it takes all the emotion out of the decision-making process. And here's the hidden power of doing it this way. Check this out. When the market dips, like it did here in Q2, and the share price drops, what happens? Well, your fixed investment, that same $10,000, automatically buys more shares because they're on sale. You end up turning a scary down market into a huge advantage, all without lifting a finger. So the action plan itself is just incredibly simple. You could literally start this today. Step 1, pick a low-cost, broad market index fund. Step 2, set up that automatic recurring transfer from your bank. And step 3, well, this is probably the hardest part. You just have to be patient. You have to ignore the scary headlines and let the system do its work for you for years and years. All right, so you've got the philosophy, you've got the plan, but what's the actual long-term payoff? This is where that simple, boring consistency transforms into truly life-changing wealth. The real secret weapon here, the real magic, it's not about being a stock-picking genius. It's about something much more powerful, compound growth. It's that slow, steady, and frankly unstoppable force of your money earning money on itself, year after year after year. Okay, let's see how this actually plays out with some numbers. After just 10 years of consistent investing, assuming a pretty standard 10% average return, your total portfolio value is already over 18 times what you put in during a single year. That's a powerful start. But now, watch what happens. This is the magic of acceleration. At the 20-year mark, that multiple doesn't just double. No way. It more than triples, jumping all the way up to 64 times your annual contribution. The snowball is really starting to pick up some serious speed now. And then, after 40 years of just letting this process run, the result is just, well, it's staggering. Your total wealth is now nearly 500 times what you invest in a single year. That is the incredible reward for patience and discipline. So, what does this all mean in real-world dollars? Well, just look at this table. It says it all. If you want to become a millionaire by the time you're 65, someone starting at age 25 only needs to invest about $2,000 a year. But if you wait until you're 45 to start, that number jumps all the way to $16,000 a year. It just goes to show you time is by far your most valuable asset. In the end, it really all boils down to this one simple, powerful truth. Time in the market is more important than timing the market. The whole goal is just to get in and stay in, letting that incredible power of compounding do all the heavy lifting for you. So the only question left is, what are you waiting for?